I'm Bill Oughton of Oughton Claims Management.
I'm Chantel Roberts of CMR Consulting, and welcome to the Art of Adjusting podcast.
Today, we're going to talk about life as an insurance adjuster from the perspective of property, auto, liability, or workers' compensation adjusters. Our goal is to bring interesting topics in the world of claims adjusting to people who are working as an adjuster now and to people who are considering a career as a claims adjuster. Hey, Chantel, how are you today?
I'm doing well, thank you. How are you?
Doing good. Sun shining. It's beautiful weather, 72 degrees. Finally, we're in the 70s. We're out of this miserable winter here.
See, I don't know because it's spring and I've got the little vest on and the sweater because it's right at that thing where if you wear a t-shirt, I'm cold, and if I wear a sweatshirt, I'm hot. So it's just like
Can't make up your mind.
ah.
When you get to that point, just get really active and get your heart rate up, and then you'll know exactly what to wear.
What? What are you talking about? I know. Anyway, we have a guest today.
Yeah. I guess it's Chris Burand of
Yes. Okay.
Burand
So,
Associates.
so our good buddy, Fred Fisher, uh, contacted me with Chris and said, "You gotta know Chris. Chris is the coolest person besides myself," meaning Fred, not me. Because you know how Fred is.
Yeah.
I love Fred. Anyway, he's like the coolest person ever. You got to talk to Chris. And we're doing a podcast or, like the seminar with Insurance Academy. And we're going to be talking about the hard and soft market. And so I'm thinking, I love that. Not a lot of adjusters know about the hard and soft market.
It's kind of the
So
other end of the business.
yeah, it really is, but it does kind of impact us tangentially. And so, by the way, if you want to know what episode that Fred Fisher was, it was February 27th, episode 63.
63. Yep.
Yeah. So, anyway, Chris, welcome. Tell us a little bit. Well, I think I know a little bit. So I was going to say, introduce yourself. Like I said, we're very casual here.
Oh, thank you. Thank you for having me. Yeah, I've been in the industry now for a little over 35 years, getting closer and closer to 40 years. And I've been doing consulting for insurance companies, insurance brokerages, insurance agencies for the better part of that time. I got into the industry and underwriting at the very tail end of the last true hard market. We've gone through two generations without a hard market, really, maybe three. And so to talk to people, yeah, I was here for the last really hard market. It's like there was a hard market sometime in the past. It's kind of a funny conversation. So I'm a certified business appraiser. I think I have the highest in the industry and the designation, and then I'm also certified to do E&O audits and expert witness. And then I also do a lot of work with analyzing carriers, analyzing the insurance market as where it's going to go and how it got here, which is obviously a topic for today.
Yeah.
So,
Yeah.
Well,
'Cause
Chris, just so that we can, educate our listeners a little bit, why don't you go ahead and explain the difference between a hard and soft market, so everybody kind of knows the foundation of what you're talking about here.
yeah, that's a great question. So historically, until um, the mid to late 90s, we would have a hard market about every 7 years. And that would last for 2 years. And then we'd go into a soft market. And you could almost, set a clock by it. So a hard market is where there's reduced capacity. In other words, the insurance companies don't have the capital, i.e. the surplus, with which to write new business. They can't. And one way of looking at it is they can't afford to grow because their balance sheet isn't big enough. And so when that happens, it's not a matter of raising prices to become more profitable or anything like that. It's a matter of saving enough money or getting new capital or getting rid of accounts. so that the amount of surplus is once again in line with the amount of premium that you have on the books. A soft market is the opposite of that, where insurance companies have more money than they know what to do with. And so they start underpricing. Generally speaking, they start underpricing. They never intend to start underpricing, but inevitably they always do. And it becomes a price game. Who will write that account for the least amount of money? And then when the losses build or their investments tank and they lose their capacity, we go into a hard market. And like I said, it used to last about 7 years, the cycle. We, starting in 2003, the end of 2003, we entered the longest, worst soft market in probably recorded history for the origins of the U.S. insurance market. Rates actually went backwards for 3 consecutive years.
Wow.
That had never, ever happened. And then now we are in the hardest market since at least the mid 80s. And it's a very different hard market from then, but it might even be a harder market than the mid 80s. This is a really awful hard market.
Yeah, but isn't it fun though? Not
Oh,
really.
it's a blast.
I
Everyone
mean,
loves
not
it.
really.
It was kind of funny, your comment there reminds me of so many young people came into the industry during the soft market and they go, oh man, this is awful. We need a hard market. And all the veterans were like,
No,
no,
no, no, no, no, no, no, no, no, no, no, no. You
no.
know, and I have been in the market for 25 years, so I kind of remember like the 90s because my dad was in the market in the 90s, so I remember him talking about it. I didn't get into the market until, you know, 2000, basically 1999, 2000. But you know, I teach risk management and insurance, and so I tell my students who are all babies, like I I accidentally asked them when they were born. I said, "Don't tell me, don't tell me, don't tell me," but they did anyway, and I feel really bad now because they were all like born in 2005, and I'm like, "Oh my gosh, I'm so old now." Anyway, like they've never experienced anything else, and you and I were talking off the air about being expert witnesses because I also am an expert witness. And one of the things that I often point to some plaintiff attorneys when they hire me is, guys, you think that this is a bad thing, but it's not. I mean, because I've got a graph in my risk management and insurance book that shows how the insurance industry has been losing money for like 20 something years. I know that you get all of these big, you, you know, headlines that say so and so is earning 5 trillion billion gazillion dollars this quarter, but that's not true technically. I mean, you know, anyway, I tell the students that it's like a pendulum. It goes back and forth and back and forth. And I think you kind of talked about this, but why do we have these swings? Besides the fact of losing capacity, gaining capacity, spending money, not spending money, that sort of thing.
Yeah. So all hard markets, and I know that what I'm about to say is going to surprise some people. I know it's going to upset some people. But all hard markets are a result of bad balance sheets. They have really nothing to do with income statements. It doesn't really matter what the profit margin is. So what you just said, last year, the insurance companies as a whole made record profits. In fact, their profits, depending on how you measure them, were 2 to 3 times higher than normal. And yet we're still in a hard market.
Mm-hmm.
And that's because we still don't have enough surplus. So surplus is what drives capacity and drives the marketplace. Surplus, and it drives claims behavior too. And we know it drives claim behavior from both sides. And so what we have there is an insurance company has to, in theory, is supposed to keep X dollars of surplus in the bank for every dollar of premium they write. Doesn't matter how much money they make, if they don't have that money stored away as surplus, they still have a problem. Now, one way to get right is to make more money, more profit, and put it back in the bank. And so what you were saying, yeah, they made a lot of money. That doesn't mean they have it to spend. That's a really big, important point that plaintiff attorneys don't get, politicians don't get, a lot of insurance company people don't get. But it's imperative for a healthy industry that we take those profits, some portion, and we just set them aside in surplus and leave them there.
I was going to interrupt real quick because I
Yeah.
think part of the issue may be the reason why people don't get it. And I talk to my students about this is the insurance industry is like the world's worst for using the same words,
Oh
meaning
gosh.
different things like
Yes.
liability. Liability could mean fault or it could mean the casualty, policy that we're talking about. And I think one of the things that gets people confused about what you're talking about is you're saying you're being very direct and very specific by saying surplus, and that is absolutely correct. If I may compliment you, as you're the expert, like I even know, like I'm going to compliment anyway. But everybody uses the word reserve, like we need to keep money in the reserve. And so I think this is where maybe plaintiff attorneys get confused, like, oh, you're making all of this money, and then what are your reserves that you've put on this file and da 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 and blah blah blah. And I'm like, those are two different words. I mean,
Yeah.
they're the same word, but they're two separate things. And there's the reserve that you got to put in your bank, and
Right.
then there's the reserve that you put on your claim file. And yes,
Yep.
both of that means that we're holding money back, but we're usually holding that money back in two separate bank accounts,
Right.
because we're not allowed to spend the surplus money. That's to keep us
Right.
from going bankrupt.
Right. 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 Yeah. Your
And the
point is really
surplus,
good.
the,
Oh
the
man,
surplus
we're
has to be,
awful about that.
I'm sorry.
Bill?
The surplus has to be in a certain ratio with the written premium. And if you're not within, what is it, 2.5 times or something is a minimum. A lot of carriers keep really close to that. A lot of other small mutuals tend to be very high. They'll have a real high ratio of surplus to premium. And I know so as a carrier gets down to that 2.5 or to that level where it's getting a little scary. And I remember at the carrier I used to work at, we would have to do a report on if there was a catastrophic loss that took out all of the properties that we had insurance on in one event, would we be able to withstand it? It was like this stress test. And a lot of carriers, especially bigger carriers, just would not fare very well if that happened. So when you're in a hard market, I'm guessing then that number, that surplus number is getting closer to the premium number, to where it's getting a little dangerous. What is a strategy for a carrier to then manage that?
Yeah. Let me go back on one point you made there. The ratios that you put out there aren't quite there. There isn't actually an official minimum. There's some myths out there that there are, and that people abide by it. But there's carriers that are pretty darn close to, depending on how you count things, far closer to a 1-to-1.
Hmm. Well, I
And
think that rating came from a company that did our they would evaluate our reserves, and
sure,
it wasn't AM Best. It was anyway. I
yeah,
digress. It was a number that one of our consultants threw out there
yeah,
a long time ago. But
yeah, it's a good number, and it's the way it used to be. And I would argue I would like to see it that way for
yeah,
the safety of the whole industry. But there's some that are playing it a lot closer than that today, and that especially if we started talking quality of surplus, not just quantity of surplus, that would definitely be a factor. So,
so
but to
talk
answer your
about
direct,
that.
Pardon?
Quality versus quantity. Does this mean maybe the type of investments they have that surplus in, or what is quality?
So quality is very fascinating, and it's something that, again, probably upset some people with my response. For opening the closet door, let's say, to the skeletons that are out there. So some big important carriers have borrowed a large portion of their surplus. They don't
Oh,
even have, it's not their money. They borrowed it, and now they have the collateral is the surplus
That is not good.
in the
no
I
form
mean,
bueno.
of
I
billions
mean,
of borrowings.
yeah, yeah, yeah. And I'm fascinated by this idea because I think I wrote a report where I lambasted another expert because he was rolling out the trope of insurance companies delay payments because of the float. And
Oh,
I absolutely hate this idea. Uh, like one adjuster is going to save the insurance company billions of dollars by delaying a payment by 3 weeks or whatever. But one of the things that I had done, and I think this happened to be Colorado, I had looked up Colorado's rules, and I think the DOI had said, for this particular book of business, it needs to be 1.5 times your total earned premiums. And I'm like, God, that can't be right because 1.5, if I'm bringing in $1, that's only $1.50. That is no cushion whatsoever. If, something happens, a hurricane, which is not going to happen to Colorado, of course, but you know what I mean.
massive
And
hailstorm instead.
yeah, yeah, and so that's really surprising. And I think for the adjuster point of view is, guys, the reason why this is important for adjusters is first question you're going to ever get anyone, as an adjuster is, well, what does my premiums pay for? And then number two, why are my premiums so high? And this would probably be this hard and soft market is probably part of it, getting
Mhm.
that surplus and all of that kind of stuff. Oh, so anyway, wow. That is
Yeah,
amazing.
yeah, and
So
there's
to
other.
avoid, I'm sorry, to avoid a hard market, we need to have insurance carriers saving more of their money.
Yeah.
Not only that, so to go back to your question about how do you fix it, is there's two ways to fix a deficit of surplus. Very basic. First way is you go raise capital. This is why you see a lot of mutual companies now demutualizing because they're raising capital by becoming a stock company. You can go borrow money like some major carriers and small carriers both have done. With different form way of raising capital. Or the other thing, and this is what you see happening, and this is I saw the lawsuit that's being brought in California
The
against
antitrust
carriers.
one,
Huh?
the antitrust.
Yeah, the antitrust one. Like you
Mm,
guys are all getting off all of these accounts. Well, the question that should be asked, and I'm not saying that this applies to the carriers in question, I'm just saying should be asked, is one of the ways in which you write the ratio is you get off of risk. Instead of increasing your surplus, you decrease your premium.
Yeah.
And so and that causes all kinds of other issues, of course, but that is one of the solutions.
Yeah, because you're exposing yourself to fewer opportunities for losses.
hmm
Well, not only that, but to get that ratio in, you get rid of premium. You just get rid of it. So in
Yeah.
this hard market right now, a lot of agents, maybe not the adjusters, but a lot of agents are probably pretty frustrated because they're having carriers say, get off X amount of premium. We don't care if it's a good account or a bad account, just get off. Or they're selling divisions.
hmm
Well, that's another way of getting rid of premium. You sell a division, but
Yeah.
you got to get rid of it. It's called right sizing.
Yeah. That makes sense. That gets your ratio looking better. The
Yeah,
ratio of surplus to premium.
yeah. That's smart. So those are the ways that
And if you're smart about it, you'll go through your book and get rid of the worst of the worst first.
if you're
Well,
smart.
You should talk
yeah.
to your
If you're
claims people for
desperate, you
that.
just get rid.
Yeah, yeah.
Yeah. Well, there's a lot of financial diets that I think insurance companies do. Usually, we feel it in the claims department, and it has nothing to do necessarily with the hard and soft market, except that maybe they're tightening their belt. And the
Mhm.
thought is, and the way that I always explain it to attorneys when I'm talking to attorneys or to the students is that think about being your normal everyday person. You got to tighten the belt in your budget. Where is that going to be? Well, that's going to be where the money goes out, like I don't know, the grocery store, or eating at the restaurants, or going to the movies. And unfortunately, everybody thinks claims is where the money goes out because we don't necessarily take money in. Now, of course, Fred and I both are like, by God, no, that's absolutely wrong. You're looking at it wrong. But it's hard to explain that concept to a lot of people. So one of the things that insurance companies will do be the hiring freezes right around with the adjusters. I would think too with the hard and soft market, does it tend to go with inflation at all? Because we've been seeing, of course, due to what was it, COVID 5 years ago, all of the prices of lumber and bricks and all of that go up.
No,
Is that part of it?
no, it doesn't really correlate to inflation. I've tested it. It doesn't. It correlates to one thing and one thing only, and that is the loss of surplus relative to premiums. And the loss of
Interesting.
surplus for this hard market in particular is due to bad investments more than it is claims.
Okay, can we talk about that too? Because I think I told you about this via email when you and I were talking. I had released a book about a year ago, and I was on a podcast tour, and this one particular podcast that I was on was for wealthy individuals, and it was talking about why have their premiums gone up and yada yada yada. And I said, well, remember back in like what was it, 2008 when we had the little dip and we're just now seeing how our surplus have run out. The guy totally didn't buy it. He was like, that was 2008. This is 2024. And I like, look, it can be 2 years because what we're talking about is going through our savings. Remember, we're underpricing ourselves, so we're living off of our savings, so to speak, like trust
Yeah.
fund babies. And the trust fund isn't bringing in the money anymore. We've spent it
Yeah.
all because of the little dip way back, and they totally did not buy that.
Right. So these bad investments were in, give or take, it was in 2022
Mm.
that really the market was already kind of trending this way, but the insurance carriers as a whole lost a record amount of money in 2022 to bad investments because their chief investment officers evidently thought that interest rates couldn't go up. And so I think it was about a $70 billion loss that year for investments.
Wow, that is a lot of money because as I explained to people, and this is consumers because consumers don't necessarily understand,
No.
is that they think, well, why is it the investments? And I said, well, I know you think that your auto premium is high at $2,000 a year or whatever for you and your husband who just drive to church and back and for your two cars or whatever, but have you had an accident lately? I mean, even just a little fender bender is what, $7,500. That's not going to cover you getting into a car accident. And goodness forbid if there's any injuries or it's your fault, so you got to pay for someone else and blah, blah, blah. I said, that's why we've got to have the investments because your premium isn't going to cover it. And neither is
No.
your neighbor's premium and Bill's premium and, Chris's premium. There's not enough premium.
There's not. It's the average loss ratio, the average combined ratio. So that's your expenses plus your claims is over the last 10 years is 100%.
which is a loser.
which was it's not
Breaking even anyway.
Breaking even,
breaking even if you don't include investment income.
right?
Yeah,
Which is
yeah.
basically losing because there's no wiggle room
Well,
if you have
I
an
wouldn't go that
emergency.
extreme.
I
I wouldn't go
would
quite
because
that extreme.
let's look at
There's
look
yeah, so
let's look
Swiss
at it from
Re's.
like a home point of view. Like if my oh, let me complain about my house. The city, I think we got like a new board member on our HOA or something
Oh gosh.
because like everybody in the neighborhood has been popped by our city for code violations. And you're like,
Oh
son of a
gosh.
biscuit, come on, dude.
Now watch
I've
your
got a
language
pencil
now,
pusher.
Chantel.
I didn't vote for him, some kind of pencil pusher here, yeah, whatever. But yeah, you thank goodness I have a little bit of an emergency fund because now I got to pay a landscaper to redivert my sump pump drain, blah 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 blah.
Oh, I
And
feel for you.
and and if I had more money in my emergency fund, I would make a great big old fountain with a cupid flipping off the HOA. But I digress.
Yeah.
Go
So
ahead, Chris. Not that I'm bitter.
yeah. So Swiss Re came out with a study a couple of years ago, and they said primary property and casualty insurers could withstand a combined ratio up to 101.5 with no problem whatsoever. This gets really deep into the weeds, probably not for your audience, but um, it's really not an issue with the investment income. I ask all insurance company CFOs this question that I get a chance to ask the question of, or CFOs in general everywhere. I ask them this question, and almost nobody gets it right. Very simple finance 101 question. What are the two components of how much money you make from your investments? There's only two.
Well, don't look at me.
The
I'm
rate of
horrible.
return.
That's your yield. So
Uh,
what's your interest rate, right?
oh, yeah, yeah.
Yeah. So that's your yield. The average yield used to be 5% for insurance companies or so. It dipped down to 3 last year. It was at 3.5. What's the second component?
Liquidity.
No.
Hmm.
See, Bill is a lot smarter in this issue than I am. I'm
Oh,
like, this is what CPAs were invented for.
I haven't
Uh,
had a CPA get it right either. Super simple. I'll tell you the answer. How much money did you invest? Because
eh,
it's your principal times your yield,
oh, principal. Okay.
right? So the insurance industry has right now about $1 trillion of principal. You can have a relatively low yield and make a fortune, right, off your investments, as long as your combined ratio probably doesn't go above a 101. So
Yeah.
we have a little bit more wiggle room than insurance company people, executives like to talk about. We don't have a lot of wiggle room, but we have a little bit, unless the value of the investments plummets like it did in 2022. And now the problem that has been caused and causing the hard market to be elongated is that rates have gone up so fast that we are still out of whack in the premium to surplus ratio. The rates have gone up faster than the surplus has recovered and or the profits have recovered. Right now, that ratio for the industry as a whole is lower than any time, even after record profits last year, than in 10 years, over 10 years. So we have some room to go before we're going to fix it, before the hard market can be fixed. And we have a shakeout coming because there's some carriers that flat out are not going to survive. They don't have any ability to recover. So it's just a long, drawn out death. But then we have others that are they're just incredibly strong and they're doing just fine.
okay, so I have read articles that's from big names. I won't mention them. We can talk off the air, but some big carriers who sat there and they've admitted on paper hey, the hard market is softening, it's ending, it's blah blah blahing, and I'm sitting there looking at it going, okay, well, I am not a financial person at all, but if we've had 20 years of a soft market, I don't think 3 years of a hard market is going to cut it. I would predict at least 10, but I mean, what do I know?
Yeah.
What
I
do you
think
say?
so. If interest rates, they would have to go up quite a bit, and nobody wants that right now, do they?
Mm-mm.
Well,
And
no,
it,
if
and if
interest
they,
rates went up quite a bit, the value of their investments would plummet again, and that would be a bigger problem.
the amount of investments in equities or in the stock market probably aren't going to be shouldn't be too significant on for of an investment for insurance companies. I mean, they all will
That
have
varies.
that, but
That varies. There are some companies where probably 70% of their surplus is in common equities. The other thing that you have out there is you have carriers who have material portions of their bond investments are in junk bonds. They're not in regular bonds, they're in junk bonds. So interest rates go up, it's going to hit the junk bond part even harder, all else being equal, in theory at least. And so that would hurt those particular companies even more. So it's kind of I would argue that we have a bit of a knife edge going on here as to how to balance this out. That being said, you have some companies out there that have so much surplus that it's not even funny. So where some of that soft market might be entering, and I read articles along those lines. Most of my clients anywhere in the country, they're not feeling too much outside work comp for a soft market yet.
Mm-mm.
Maybe a little bit here and there is that the companies that have unreal, so there are companies out there that have almost $4 of surplus for every dollar of premium. And they've been riding the wave. Maybe those are the companies that are saying, okay, now we're going to go for market share because we can write for a lower premium. The companies that still don't have their financial act together, it's time for them to go away. We're just going to go start taking their business. Right now in the marketplace, that would probably be, I would expect that to start happening right now.
a
A
lot of
really
the
good time
small
to be there.
mutuals that are in my world here, they are very well capitalized. So their surplus is, like you say, four, some five, six times in some cases. Um, and these hard soft markets really don't affect them as much. They'll all complain about the agents all complain about it, of course, but
Right.
because they're writing for all different carriers. But these small little mutuals that have, less than $100 million in premium, some far less than that, seem to do pretty well. But these are companies that have been they're all formed back in the late 1800s,
Mm.
and they're kept really small, very conservative. They've got 10% in equities, if that, as their maximum, and everything else is these laddered bonds, and they just kind of keep expenses low, and they're a good model. But the big companies, it's difficult to manage a big company in the same way, I think.
Yeah.
Uh,
Yeah.
Reinsurance is a huge part with these smaller carriers. That takes a huge chunk of their premiums. Um, but that happens with the big guys too. So
Well, and I analyze 90% of all P&C premiums in the industry every year in detail. I mean, I really do this. And I'm not any longer a fan of delineating carriers by small or large, mutual or stock. It's all over the board. Bad management pervades all channels.
It's interesting because
good
again,
point.
what my RMI book shows when we're talking about finances is what are some of the reasons why our companies go bankrupt? And one of the biggest ones is bad investments and bad management. And you're talking about, the junk bonds and the bonds and all this kind of stuff. And I have a little pie chart that shows how or what insurance companies invest in? Because I think we hear the word investment and we're all thinking stocks, like Walmart and Pepsi and Coca-Cola and Google. And it's like, no, there's like property, there's real estate in there, and there's this and there's that. I mean, it's only like 2% or whatever, according to my little pie chart. But they get surprised by these sorts of things, I think.
Yeah. There's a lot more variety than people think. And the good conservative companies are pretty vanilla. Vanilla is good in insurance.
Yes.
It really is. You get to tapioca in insurance and something usually is going to go wrong.
Rocky Road.
Yeah, Rocky Road.
Okay, so what about chocolate fudge peanut butter chunk? Is
Yeah.
that gonna be okay?
No.
Yeah,
Do we need to get Ben and Jerry's in here because they are a New York firm? Bill's in New York. I think I sense a marketing sponsorship capabilities here. Bill, you
I
want to
think
take care
that's a
of
good
that?
idea too. Yeah. So let's talk about combine what you just said, Chantel, and what Bill said about reinsurance, because it's a really important point as to how we got to this place in the hard market, and it's surprising to people. And the reinsurance factor for these little mutual companies is going to become more problematic, especially for the ones in the Midwest. So there's two parts of the reinsurance story. The generic one overall for the industry as a whole is back in 2018, which is really the approximate date of what has caused this hard market to be what it is that the insurance companies as a whole forwent. In other words, they did not buy a record amount of reinsurance in 2018. So for your listeners that may or may not know how this works, let's say you have a $100 premium and you buy reinsurance that takes $5 off the books. Your net premium is now $95. It's not $100. So you've been buying reinsurance all these years and your direct premium's $100 and your net premium's $95. But you decide, because you need to save some money, your expenses are too high or whatever the case may be, that you're no longer going to buy reinsurance. So your net goes back to 100 and your growth rate accelerates. So if I need to show higher growth and I'm running an insurance company, I just don't buy reinsurance. And I get an immediate uptick in my growth rate. So in 2018, the carriers as a whole more than doubled their net growth rate by not buying reinsurance.
Not buying it at all, or just increasing their retention, or
they increased their, well, some carriers almost went to no reinsurance. Others just, less. But the growth rate should have been about 4% in 2018, and it jumped to over 10% with really no material rate increases. That's how I identified what happened. And I was able to later back into it and figure out and confirm it. That was a really rather bad time to roll the dice, because not that long after, we had the derechos in the supposedly safe Midwestern states. And some of the carriers that rolled the dice happen to have a preponderance of business in those states. What made it worse, a lot worse, is that some of the primary mutuals, smaller mutuals that you may or may not have been that you're thinking of, going back to a deal that was made with the politicians in around 1910, give or take, these smaller Midwest or mutuals, by and large, some larger, had agreed to provide effectively what's called unlimited reinsurance, property reinsurance, to these little itsy bitsy mutuals and county mutuals, what have you. And the derechos came through. So not only did that mutual in their own backyard have really high loss ratios, they now have basically unlimited reinsurance loss ratios on everybody they had reinsured. Their reinsurance loss ratios per the NAIC at times went to 999.99%. The
Wow.
NAIC can't go to 4 digits,
Right.
right? So we have a situation where some people decided not to buy reinsurance. The derechos came through. They didn't have a spread of risk like they should have had. And then a couple of years after that, we have interest rates go up, bond portfolios fall like there's no tomorrow, and we have a surplus issue. It's
Yeah.
that compounding of different events that's created such a horrendous hard market.
And I think the just to throw stones just because we can and there's no one here to defend them, the reinsurance or the reinsurers, like back in Florida or what have you. I mean, they took their sweet time in reimbursing the underlying insurance carriers so that they're robbing Peter to pay Paul or what have you. And that's one of the reasons why some of our carriers in Florida and Louisiana went insolvent.
Yeah. Yeah. And obviously you've got it as a carrier level, you need to do your due diligence on your reinsurers, right?
Yeah.
I don't know if it's still true. A few years ago, it was true though. And this goes back to the question of surplus, is that there's no, if I remember correctly, there's no regulation that requires the primary insurer to reconcile with their reinsurers what the reinsurance recoverables actually are.
So the underlying doesn't have to say you owe me $5, and if the reinsurer gives them $3 instead of $5, there's nothing that the underlying can do. Is that what
Well,
we're
this
saying?
is a
They
payable
don't.
and a receivable, right? I can say that you owe me $5 and the reinsurer can say, no, I only owe you 3. And until it's resolved, they can keep their books that way.
Right, right, right. And I think that's that might have been part of the issue with Florida as
Hmm.
well. Yeah,
Yeah,
because they're not getting all of the money, and then because they're relying on reinsurance to pay or reimburse,
right,
maybe they're not keeping the surplus that they need to do, and
right.
and what.
So reinsurance recoverables is part of the calculation of how much surplus a primary carrier has,
Okay.
right? And so for a real strong carrier, you're looking for reinsurance recoverables to be an itsy bitsy amount
Mm.
percentage wise. There are some carriers out there that are probably in the 20% range of their surplus.
If
Is
you
in,
just think about this as a book of business, you don't want to have bad debt on your book of business of 20%, like bounce checks of 20%. It means you're not getting out of you're getting 80 cents on the dollar or something like that. And
right.
I am not a great business person. But even I know that. I'm an insurance nerd, not a business person. So that is,
Yeah, it's there. Like I said, some people might be upset on covering things here and they may argue, but I use the NAIC data. I use AM Best data, and the numbers are the numbers. As I have told several insurance company CEOs, if you don't like the numbers, then refile your NAIC filings.
yeah. That is just absolutely. And you said, because this is one of the questions, and I found it really, really interesting, that the hard market actually started in 2018, which is a
Yeah, that
lot
was
earlier than what most people think. I think most people think it started in what, 2022, 2023, somewhere around there,
yeah, that was
maybe.
the approximate date of the start of it because they didn't buy reinsurance, and it was hidden for a little bit because of COVID because the carriers had to give back so much money because no one was driving during COVID. So that distorted the market quite a bit for 24 months. But it really did start in 2018. That's where that's where the inflection point is.
Yeah. So just for fun, what's your foreseeable, like when do you think is it going to be 2028, 2038, 2138 that we're going to go back into a soft market? I don't.
I don't know.
It's
This
something
is
fun.
one heck of a market.
Mm.
Um, what I don't think that we're going to have an overall resolution to it either. We have some other issues that have now entered the equation that are that don't have really anything to do with surplus for the first time. The two things that have entered the marketplace that really are really quite new are some of the litigation out there is creating a situation in which you can't price it. You simply can't price for the litigation potential. So it doesn't matter how much surplus you have, you just can't write it at any price.
We're talking, and I'm going to venture a guess. The first one would be the nuclear verdicts, which, by the way, I found out was a like a trademarked term, and we shouldn't use the word nuclear verdict. But I mean, that's what everybody uses. It's like
Right.
using Coke or whatever. It's whatever. That's what we're going to say. So we should say like excessive verdict, excessive
Let's use
verdict.
excessive verdicts because it's not just the nuclear kind.
But
It's
it's also because my second guess would be the third party litigated funding.
the third party litigating funding is a real issue. It's a true issue, especially given the fact that we don't know the sources of some of that third party funding.
So if you don't know what that is, I'm going to give you my very uneducated, because I've only read one or two articles on it. And half the time it's written by attorneys, and it's even a little bit above my head when I'm reading the articles about it. They use really big words. But essentially, it's like a venture capitalist coming in and buying the claimant's case. And the venture capitalist, will give the plaintiff attorney money and say, go ahead and file suit. And when you get that billion-dollar verdict or whatever, I'm going to take 20% off the top of it or whatever.
Yeah,
And it's kind of like having empty or deep pockets, and so plaintiff counsels are saying, hey, we've kind of leveled the playing field because insurance companies have
mhm,
deep pockets, yada yada yada. We've got all of this money, and I'm like, no, we don't.
yeah,
We don't, but that's okay. And the issue is that the funding isn't really very clear because sometimes I think there's some bar rules that say you can't do this and you can't fund this way, and the money has to come from yada yada yada. And it's a morally and ethically gray area where this money is coming from.
in theory, but it's pretty popular. I don't know what the current number is, but I think I saw something that said is the funding was in excess of $10 billion at this point. So
Mm.
I think that's part of it. And keep in mind too, though, the insurance companies are playing both sides of this because insurance companies have a policy out there called judgment preservation now.
Really?
Yeah, so
Tell me about that.
Yes. Let's talk insurance coverage.
so let's say, Bill, that you go out and you win a verdict for $50 million dollars, and the loser is appealing that verdict. You can buy, in theory, you can buy an insurance policy that says if your 50 million is reversed upon appeal, the insurance company will write you a check.
Interesting.
Wow. That is
It's
interesting.
almost like they're shorting their own
Mm.
defense.
Isn't it right? Exactly.
Okay.
So
Interesting.
I have an issue with this because the thing is that insurance is supposed to be a fortuitous loss. It's supposed to be based off of a fortuitous loss. Fortuitous, as I explained to my insurance kids, that big old fancy word meaning by chance. Is it really by chance, or are you gambling? I mean, because it's kind of like a 50-50, isn't it? If you're either going to keep that 50 million or you're not going to keep that 50 million. So how can you issue a policy? Well, I guess you could if you were in this excess surplus lines, not the
not even excess surplus, but for anyone that wants to go look it up, look up the IBM case where IBM won on reversal, and it cost the other side's insurance company a minor fortune because they had insured the verdict against IBM. IBM won on reversal.
Hmm.
It's a pretty fascinating deal. And like you said, I kind of think it violates the whole fortuitous aspect of it myself, but
Yeah, but you
It's
know
it's
what?
almost like they're being too smart by half too, because they're
Hmm.
they're they're trying to capitalize on a they're speculating, trying to capitalize on a situation that may or may not occur. And if they lose pretty big. It sounds like.
Yes.
But that's gambling. However, some would say parametric insurance is not fortuitous. So, I mean, that's a whole nother podcast.
That's another podcast.
That's
Yeah,
a
I
whole
would
nother
argue that
podcast.
there's some material differences there, but yeah, and so I think insurance companies offering that policy effectively are third party financiers as well. And so, you know, it's going both ways. I'm not sure it's healthy for anyone to be going down this road, but so that's part of it. The other part, though, is, and I know I'll upset people with this one, but the other one is that the insurance companies have decided to not think about property underwriting. And so, especially out in the West, where I live, humongous areas have been mapped out as wildfire risk, and therefore we won't write there. And it doesn't matter if it's really a wildfire risk or not. There's just not a market if the map, and most companies are using, I think, the same map. And it's an old-fashioned form of redlining. There's nothing else
Oh,
to
that's
it.
what I was just getting ready to ask you. I was like, oh, is this redlining that we're
It's redlining.
seeing? Oh,
Yeah, it's redlining. You can call it what you want, call it green lighting, because it involves the environment instead, but it's the same thing, right? But we call it a wildfire map, and we say we're not going to write anything within this wildfire area. Well, when most of the state ends up being a wildfire area, why don't you just pull out of the state and be done with it? But I'm going to give you an example of why this is really bad, why it's going to cause the property hard market to be hard for a lot longer, and why it's stupid. So, in fact, we're going to run a contest through my newsletter and podcast that says, where is the wildfire risk? And this is the example that we're using to start the whole thing out. There's this one little tiny restaurant out in the desert could not get any insurance, any property insurance. So I went to Google Maps and mapped everything out. The closest flammable material that's wild and you think about it on a 360-degree angle circling this little restaurant, okay? So out of 360 degrees, 1.5 miles away, there's flammable wild material that takes up about 20 degrees of the 360 degrees. Okay, 1.5 miles away. In between the restaurant and the 1.5 miles is pavement and buildings and highway. And the highest flammable part is, let's call it 3 feet tall and sparse, because we're in the desert. The other side of the restaurant, once you get past, because there's concrete going north and south for about 5 miles, 6 miles. And so if you go to the other side, the western side of this, there is no flammable material because it is all sand. It's dirt. And there isn't a market that will write it because of the extreme wildfire risk.
see,
Right.
I would have thought because the fire department couldn't get out there in time.
It's in the middle of city limits.
Oh,
It's in the middle of city limits. It's a protection class 5. It's not a problem whatsoever.
how interesting.
And
So this just happens to be within the map and
Yeah.
ticks a box,
ticks a
Mhm.
box.
but there should be other boxes that should be ticked.
There
Yeah.
should be a human going, this makes no sense.
Right,
Well-
Let's apply some brains to this.
right.
That's what should be done.
Let's talk about since the insurance companies have so much money, and this will probably be like my last question, and it'll lead us into like 3 hours of conversation, I'm sure. Because here's my unpopular opinion. Since the insurance companies have so much money, as we've been talking about, why aren't they doing more grants to where we have these hurricane-proof roofs. There's this whole, movement in Oklahoma and Louisiana and Florida and North Carolina, South Carolina, where you can petition the Department of Insurance or the state or whomever, and they'll give you like a $12,000 grant
Mhm.
or to get a hurricane-proof roof or uh, a windstorm-proof roof in that particular instance. And if it's a lottery like it is in Louisiana and Oklahoma, you might not be able to get it. And these roofs are kind of expensive to add. And so why aren't we putting our money where our mouth is? There is a TED Talk by a gentleman, Ted Hornsby, I believe his name is. He is a professor at Duke uh, in North Carolina. Isn't Duke in North Carolina? I don't know.
Yeah.
Anyway, he's in North Carolina, and he did all this math, rolled it out, and within 5 years, they ended up saving millions of dollars, their little bitty regional
Yeah.
carrier. And so I just sit there and go, why don't we put our mouth money where our mouth is? Why aren't we offering out in California um, loans, $5,000 loans to help you build with cinder blocks rather than wood? Because we're all going to be rebuilding with frame wood things because it's quicker and it's
Yeah.
cheaper.
Quicker and cheaper for sure. There's a lot of problems with that. I think I'm a big fan of crediting people that do that and offering bigger credits. I think the credits are too small in many ways for wherever you have hardening, especially hardening for hail. Um, I think that the insurance companies look at it and say, what's the return on investment? What prevents the client, once we give them that and we have a safer account, what keeps them from going to another carrier? So I think that's a fair point.
It's a fair point.
That's a fair
We
point.
could offer things such as much like we do, and I don't know if this is legal because rebating is illegal, but you could do something to the effect of much like they do for nursing students or for doctors.
Yeah,
Like we'll put you through school, but you have to serve in our, rural area
that's
for three
possible.
years.
So
So,
in times gone past, insurance companies actually offered lifetime auto and lifetime homeowners policies a long time ago. And in the 80s, even in the 80s and 90s, they were still doing it. So that is feasible if they would go back to that. Let me correct one thing that you said. Rebating isn't 100% illegal any longer.
oh, okay.
And it actually is one of the avenues that we could use to fix this.
Hmm.
So the NAIC passed the model law, I think now it was 3 years ago. And the model law says that at the agent broker level, rebating is now legal if it is used in coordination with loss control risk management.
Okay.
It can't just be a cash rebate. It has to be that we're going to give you these services, these ways to minimize your risk, and we'll take it out of part of our commissions to do that.
Thank you. Yeah, because I kept wondering, my students keep going, well, we're just going to give them a rebate. And I'm like, guys, it's illegal. You
Yeah,
can't.
until
Okay,
three
well, they're
years ago,
learning something that I don't
yeah,
know.
and most states haven't passed the model law yet, but a few have. So there are a few states now where you can do that, and I applaud it. That makes all the sense in the world. It's good for the consumer.
So what's the difference between that and like a non-smoking credit that you get in your homeowner's insurance?
So that's at the carrier level, and the rebating law allows the agent now to do something along
Okay,
those
got
lines.
it.
So it's
Got
the
it.
difference between the carrier and the agent
Got
and
it.
what they can do. So
But if the
carriers can
agent,
always
if the
rebate if they want.
Hmm.
right, so if the agent is doing something that lowers this person's risk, then it would be allowed.
Then it's allowed, Jen, but they take it out of their commission instead of, and then depending on, there's a lot of ways that you can finesse that, let's say,
Mhm.
but in my world, that's good. That's awesome. we can make the world a better place by doing that. Let's make the world a better place. I'm all for it.
Absolutely.
I thought that was good innovation at the level of the NAIC. I hope more states agree to it. I hope more states go along with the hardening. And I also think that it makes a lot of sense because the carriers are reluctant to think where a state says, look, if someone hardens their home, dear state, or dear insurance company, you've got to credit it accordingly. Because the carriers seem to lack resolve to do it on their own. So somebody's got to force them. It's a sad commentary, but it's reality, right?
Yeah.
I
Yeah.
mean,
But I mean, carriers are always looking to be more competitive too. And if they can, if they're smart and they see that someone is protecting their home from wildfires through some sort of, material that they're installing on the outside or whatever, and they can offer that discount, I think that would make sense for them because they're lowering their risk.
it make a
Yeah.
lot of sense,
You
but they don't
can't
do it.
tell me, you can't tell me that if I didn't get $5,000 or whatever to put a new roof or to put a hail-proof roof, because I live in Kansas, on my house from my insurer, that I wouldn't be more loyal to my carrier. I mean,
Yeah,
that's good customer service, but again, what do I know?
For
it is.
carriers with a surplus problem, that could be an issue though, if you just start
That it
raising
definitely,
prices.
way to bring it back full
Yeah,
circle, Bill. Way to bring it back full circle because I was going to say we are unfortunately out of time.
yeah.
Ah,
Yeah, and what a fascinating conversation.
it
What
is. It is. And
absolutely.
it's fairly far removed from the claims process. So it's good for claims people to hear this this part of the business and how, how these investments, how reinsurance affects things. Your daily on your daily travels in your claims handling, you're not going to come across this stuff as much. But it's good to know how these companies work. And you might get some insight as to why a carrier lays off half their claims department one day.
Absolutely. Yeah. And it's
Without
always good
question.
when you want to move through the ranks to know how the carrier works. Chris, where else are you going to be talking? You mentioned a podcast, you mentioned newsletters. How can people get that information?
I'm going to be, I don't know when you're publishing this. I'll be speaking at NetView next week.
With Thursday.
What's the date?
I will be speaking on
This comes out.
May 8th
May
Um,
8th.
oh, now I
at
got to look at the
NetView.
calendar.
And I'll be speaking at the Florida Convention in June.
Okay.
And
This podcast here will come out on May 8th. Okay, so
okay,
when
so
in
now I'll be
when
at
in
the Florida Convention speaking on June 19th. I do presentations for the Insurance
Where
Academy.
else can they follow you where you might
yeah.
have
They
these
can follow me
dates
on
posted?
on LinkedIn. They can follow me for my newsletter. Just send me an email, ask for a newsletter. It's free. I'll be speaking at the Insurance Academy on June 5th. And then we have a podcast that comes out about every 2 weeks. So that's some of the places where you can find me.
Awesome. Well, thank you so
Great.
much,
Oh,
Chris.
yeah. And read my monthly column in the Insurance Journal.
Ooh, I love that.
Oh, absolutely.
Yeah, because I actually give the students uh, a lot of articles from the Insurance Journal
Okay.
as discussion questions and to help explain what is going on in the greater insurance world. So I love that. Well, I'll sit there and go, "Hey, I know this guy. That's so cool."
Yeah, it's church. I do a monthly column there, and they give me the luxury of writing about any subject I want to write about.
Oh, that's
Very
awesome.
cool.
Well, Chris, thank you again. I appreciate you spending some time with us. Our
Yeah.
next episode, this one's going to hit on May 8th. Our next episode is going to hit on May 22nd. And we're going to be speaking with Amy Cooper and the founder and CEO of Rise Professionals, which helps young insurance professionals connect with one another. So you won't want to miss that.
Yeah.
Thank
All
you.
right. Thanks, Chris. Good to meet you.
Thank you.
Take
Bye.
care.
Thank you.
Bye-bye.
Bye-bye.
Thanks for joining us on the Art of Adjusting podcast, where we talk about life as an insurance adjuster.
If you enjoyed this podcast or this episode, please give us 5 stars and a review. It does help the algorithm pick us up.
Hit that subscribe button real quick and tell all of your adjuster friends to check this out as well. For independent adjusting services, go to www.autin.claims. And for anyone interested in working as an independent liability adjuster, go to the Contact Us tab to join our roster.
In the meantime, you can contact me at theartofadjusting.com for consulting and training purposes.